Hello everyone, welcome back to the weekly English class, and we shall start the lessons later on. Yeah, let's wait for about 3 to 5 minutes so that we can let the others to join. Please be patient, and we shall start the lessons right away after I would say 3 minutes. Let me check on the time. It's 7:59. Okay. And we have stopped the English class for a week because due to the New Year's and also the Christmas. And we expect that most of the people will go for a holiday mood. So we have stopped for a while, and then now we will start our English class again. And right now we are going to have a series of practical class, and this is the first class of the practical class, and we will talk about how to do the options in a single leg, which is very easy for the beginners to pick up. So if you are a total beginner, do join for our weekly class so that you can learn how to, just pick up options, and then you can just directly go into how to trade the options right away. And today's we'll be sharing the single leg options, which is the call options and the put options. And compared to the previous theoretical class, I would say, it's quite boring, the theoretical class. So now we want to do it in a more practical way, which we will cover some of the stock selections and also the option selections. And we will ignore some of the technical point, and we will just go into the most important part of picking up an options. So yeah, since there are many theory and knowledge to cover, but not every one of them is important when you doing a options trading. So right now we want to try to get everyone able to just pick up options in a single class. So right now we will just pick the most important part out of all of those. So for the first class, we will talk about the single leg option, which is the call options and the put options. And for next week, we will talk about being a seller instead of a buyer. There are ways the patterns, the trading style will be completely different, and it will be suitable for different group of people. And yeah, we will talk about it later on. So next week, I think we will cover the seller part. And then for the following weeks, we will cover the vertical spread. And if you are a pro member, you will know that every day we will release some of the strategy, and most of them will be in the vertical way. So if you learn about how to do the vertical tradings, vertical option strategy, then you can just join our pro member, and then you can just follow our strategy along, and then try to make money all together. And then for the last class in the month, we will have one practical class every week, and then along with one advanced class. Advanced class, we will have, we won't fix the topic. And for this week, the advanced class will be tomorrow, and then we will talk about the summary of 2024 and a heads up on 2025. So we will just cover about how to start your trading journey in 2025. And in January there will be a Trump's events and also the CES events, which will affect the AI and tech industry. And then for January and February, we also have many financial report is going to release. So we'll just talk about all of those in tomorrow advanced class. And then get back to the topic. So in the series of the practical class, there will be 4 classes. First one is this class, which is the single leg call and put options. And then for the next week, we will have a seller class. And then the following week, we will have a vertical strategy. And then for the last week, we will talk about doomsdays. which is the most exciting options trading strategy. And then let's check on the time. It's already 8:04. Let's start on today's class. I'm sure that everyone able to see my screen, right? Let me check on it, yeah. Yes, it seems like the screen is projecting well. Okay, so let's start on today's class. Today's class, we will talk about options. And if you have joined for my Mandarin class last week, I have talked about this class in last Monday, actually. And today we will talk it in English, and hopefully we can cover it and get you guys to start your option trading journey. So today's topic will be to discover how simple the options tradings can be. Options is actually very simple. It's not like the other people say it's very complicated. It's a gambling tools. It's actually not that way. But there's multiple ways to trade the options. Like you can make a single leg, a two legs option, a three legs or four legs. You know, the iron condos, the vertical spread, and yeah, there's tons of strategy there. But trying to make it as simple as you can, then you'll find out that actually options can be very simple. And then the simple ways can also make you to become profitable in the market. You don't need to learn so many complicated strategy. And today we'll talk about how simple the options can be, but we won't cover every theoretical knowledge. Yeah, we just cover the most important part. If you are a total beginner, I believe that you will benefit greatly from it. But if you are already an expert, I also hope that you can, gain some knowledge or different point of view from it. Just a disclaimer, because later on we will go into the practical part, which I will show the way of selecting the stock, and all the stock here is not a buy call or sell call. It's just for the illustration purposes, and it's just for the education purposes. So this is the disclaimer to avoid any unnecessary trouble. And then this is the process for today's class. First of all, we will have an opening right now, just like what we're having right now. Yeah. And then we will to have a theoretical explanations, and then afterward we will have a rest and a Q&A sessions, and then we will go to the real stock pick and the operations on Usmart interface, so that I can make sure that all of you can able to just select your stock, start your trading for 2025, and then maybe we can pick up some very good stock today and make our first profit for the new year. Okay, so this is the rough process for today. And yeah, just talk about the opening. Let me have an introduction of my own first. My name is Hu Junlo, and then I have 4 years of experience in fund management and 2 years specialized in building the algo board and also the quantitative trading. And now I'm a senior financial analyst and trainer for Usmart, and then hopefully I can deliver some very good knowledge to you guys and sharing some experience, and hopefully that we can make some great money together and getting retired earlier, or just start from picking up some pocket money first. So first of all, what is options? Because options have a very long, tedious explanation way. So I would prefer to just compare and refer to a another physical case. In this case, which is like option is just like placing and booking when you purchase a property. So when you want to purchase a property, and let's say that the property is worth 600,000 and you want to buy it, but you are not sure about is it now the correct timing to buy it or not, or you have other concern to consider about. So you want to place an order first and lock in the price. So now you place a booking fees, you pay a booking fees, and then you book the property under your name by locking the price at 600,000. So in that way, if later on you are very confirmed they want to buy the property and the property price go above 600,000, it's like going to 650 or 700. So in that case, you are able to just utilize your agreement and buy it in the price of 600,000. So this is just exactly the same like options. Options is the booking fees, the booking tools in the financial market. So when you want to buy a stock, but you're not sure about whether you want to buy it right now or later on. So you go to options and you buy a call option. And that way, you will be locking the price of the share at the current price or any desired price. So option is actually just like a booking tools, a booking fees in the financial market. But the underlying asset is not a property, but the share and maybe some ETF. So options is actually just the booking tools of the booking fees for the financial market, as simple as that. So later on, we'll go into the example and you will see how the option works in theoretical way, and also how are we going to do the option, trade the options in the real world situations, the practical way. It's different, yeah? So this is the basic elements of the option. First of all, you have the strike price and you have the expiration date. And also the most important thing is the premium, which is the booking fees. When you're comparing or referring to the last example, premium is the booking fees. And the strike price will be the lock property value in the, I mean, if you're referring to the last example, it will be 600,000. So the strike price is the locking price, and the expiration date is just the period that you can exercise the agreement. If you already way past the expiration date, then these options, this booking will gone and have no value left. It cannot be executed. And the premium is actually the booking fees. So this is the three most important factors for options. And later on in the practical part, I will also talk about how to pick the options in this different angle, like how to select the strike price, how to select a very appropriate expiration date, and what will be affecting the premium. Is the premium in a very expensive way or is in a very cheap pricing that worth for trading? Just like stock have a say that every stock have a fair value. So I believe that option do have a fair value too. So we will talk about how to identify the options fair value, and then it will let you know the premium that you're paying right now is expensive or cheap. Do bear with me. So this is how the options will look like in written terms. So this one is GLD 25 January 17. And this one is the strike price, which is 244. And the last term is C, which is referring to the call options. In this case, it's referring to the bullish situations. We have a call options and we have a put options. And we will be focusing on the call options for today's class and maybe slightly bring through the put options. So how do we read these terms? First of all, the first one is the stock, is the underlying asset. So this options is actually for this one, which is the gold ETF. And then the expiration date will be January 17, 2025. So that if you buy these options and this option expired, like yesterday is the January 17th, then your option will be gone and you cannot execute it anymore. And the strike price here is 244, which is referring to the locking price. So in this case, you actually, if you buy these call options, you are expecting that the gold ETF will go above 244 in the future. So let's say Now you bought these options. And then before the January 17, gold ETF do go up like 300, 400. Then you can execute these options and you can buy it directly from the seller at 244. In that way, you can buy it from the seller and you can directly sell it to the market at the market price, which is the 300 or 400, whatever it be. And you will make an immediate profit. So this is how the options work. When you buy the options, it's meaning that you actually have a bullish view on this underlying asset, but you are not sure about will it go up, really go up? So this like kind of like a testing bits of it. And if it really goes up like 300 and 400, then you can just execute and buy it at a cheaper rate. And then you can make an immediate profit. And that is the case of you exercise the options. Then you can only buy it from the 244. But most of the case, we as a trader, we don't exercise the option. Let me tell you why. Most of the traders don't. You need to remember this. And first of all, it requires a lot of capital because one option is actually referring to 100 shares. So if you're referring to the last example, the strike price that you are locking is 244, which means if you really want to execute that options, you will need to buy 100 shares of the gold ETF at 244, which means you have to pay 24,400 for exercising the options just to buy 100 shares of gold ETF. So this will be a little bit contradict with the primary code that we trading the options, because when we come to the options, we actually want to just use a very small capital to make a very huge gain from market. So if we don't have that kind of capital, then how are we able to execute? If you don't have that capital, you are unable to exercise your options. And you can only selling that call options to the others. So I bought these call options and I don't have the money to exercise, then I can only sell it to the others and make the profit from just buying and selling these options, but not exercise that. So first of all, if you want to exercise the option, you will need a lot of capital to do so, because one option is equaling to 100 shares. So it is contradict to our scenario, because we want to use a very small amount of money to make a huge jackpot from option trading. And the second reason is it's very complicated. Why? Because when you exercise, you want to buy 100 shares and you want to sell that share to the market. And it takes time in the duration, so it might have a little bit of the price fluctuations, and you might not able to get the price that you desire. But if you are selling the agreement right to the others, then you won't experience this kind of thing. You won't have to tolerance the price fluctuations and also the time taken for all these process to be executed. So it's very complicated. So why you don't just buy and directly sell to the others and make a profit from it? So most of the traders, this is what we do. We trade the options and we gain from the difference in the premium. Let's refer back to the booking fees scenario. So if I want to buy this property in 600,000 and I place a booking fee and I pay the booking fees in options will be premium. And in this way, if the property value goes up to 700,000 or 800,000, in that case, I can profit from just buying the property and selling the property to the market, right? But I don't have the money to do so. So what do? I have this booking agreement. I transfer my name to the others. I sell this booking agreement to the others. And let's say previously I placed a booking fee of 1,000. Right now, I'm selling this booking agreement to the others, and I'm selling it in 2000s. In that way, I make a double, right? So this is what we talk about trading the options. We just transfer the options name to the others, and we actually just buying and selling the options, buying and selling the booking agreement. That will be what we call trade the options, and we gain from the difference in the premium, but not from the exercising and from buying and selling the property. So most of the trader, we do this kind of thing. We trade the options and we gain from the difference in the premium. And this is the gold ETF options. And actually, option is a game of the time and the space. Let me talk about how. First of all, this is a gold ETF, and this one is actually the expiration date. And you can see that this is the time durations from the time that I've captured these pictures. So it has like it has some space until the expiration date. And the 244 is my strike price. And you can see that this black line is my strike price. And this is the call option, which is having a bullish view on this gold ETF. So if in the future it goes up into this green zone, I will be in profit highly. I won't say 100%, but most of the time, 90% of the time, I will be in profit. So the minority part will be there will be some case that I'm not able to profit even though it fall in this green zone, which is like the volatility squeeze and all those. And we will talk about how to avoid those in the upcoming part. Because even though we are picking up the stock in the right moment, in the right directions, we also want to ensure that the premium that we pay is in a cheaper rate. So if we are paying the premium is in a more expensive way, even though the price goes up in later on, but the premium rate drop. So the gain from the stock rally cannot cover the drop in your premium rate. That will be the minority case. But we will make sure that you guys won't fall into this kind of mistake, and make sure that you guys picking up the options is in a cheaper rate or in a fair value rate in the upcoming part. Just later on in today's sections, okay? So this is the interface of the options trading in Usmart interface, the handphone mobile. So you can see that in the option interface, you can check on that for these options, the premium will be $4.41. And this is how you understand this. When you are buying these options, you're not only paying $4.42, because we already say that one option is actually equal to 100 shares. So instead of $4.42, you need to pay 442, because this premium is for a single share and you need to pay for 100 shares, and that will make it into $442 when you're buying these options. But it's still better when you're comparing to buying 100 shares of this gold ETF, because right now the gold ETF is allocating at 244. If you want to buy 100 share, it will cost you like 24,000. So when you're comparing to 442 to 24,000, there will be a very huge difference. And right now we will talk about how options compare to the share and compare to the futures. And I will talk about the benefit of why we play option instead of the share and also the future. When you're comparing to the share, the most important part will be the leverage. Let's say in this case, the gold ETF goes up to $250, and if you buy a share, you'll make a gain of 2.46%. But what about if you buy an options? There will be a leverage effect. And how to calculate it is very simple. If you just go to the interface, you don't need to care about the other things. You just have to check for one thing, which is called the effective gearing. And in Chinese, it will be 有效杠杆. So in these options, for that particular strike price, you can check that the effective gearing will be 27.65x, which means this effective gearing is actually the multipliers, the effective leverage for these options. So when the share price of gold ETF goes up from 244 to 250, there will be a gain of 2% something. And the premium, the option premium will go up from $4.42 to become $7.42. There will be a 68% gain when you're comparing to buying a share because of the effective gearing. Just as simple as that. But this one is actually the rough estimations because when the times goes, there will be a time decay. So as faster the price go into your direction, you'll be more accurate. So if it, just fluctuated here and then it goes up into 250, just near the end of the expirations, you might not be able to go up to $4.42. It might be around $5 or $6 something. So that will be the case because the leverage effect get to deducted by the time decay. So as soon as the price go into your direction, this effective gearing will be more accurate. So when you're comparing to trading the options and trading a share, this is the difference. By using the same capital, you're able to get tons of gains when you're comparing to buying a share. That is the most important difference when you're buying the option and the share, the leverage effect. And how about when you're comparing to futures? Futures also do have a lot of leverage effect. Sometimes it might be greater when you're comparing to trading the options. So the main difference is the tolerance. If you buy a future, this is usually how people do. If I want to buy in this current price, I will set a stop loss. How? Either I will set it in the previous support or resistance, or the even lower one. But I will have a stop loss no matter what. Else I will just become a gambling and then I will make my account blow someday. So this is how the usual practice. We do set a stop loss if you want to pay a future. So this is the scenario in future. So sometimes you get stop up before it go into your directions. So you can see that even though it's falling into this green zone later on in the future, but you do get stop up and you're not in that trend anymore. So this is the disadvantage of trading the future. So if you trade the options, you can avoid this kind of thing happen. So future have a greater, you need a greater accuracy when you get into you need to have I would say, a sniper entry. So not to get your stop loss get hit. And you have a lower tolerance on the fluctuations. But if you trade option instead, you don't have a stop loss. As long as it fall into this green zone in the future, you are high likely to be in profit. So even though if front load, it goes up, it go down, or it just, staying there, didn't change anything. But at the end, if it goes up into this green zone, you'll be in profit. So this is the comparison tables when comparing to the share in the future. So if you trade the options, you have the leverage effect, but if you trade the share, you don't have the leverage effect. If you trade the future, you do have a leverage effect. And the tolerance part, options have a higher tolerance when you're comparing to the future. And when you're comparing to share do also have a higher tolerance because some people, they just goes from a short-term traders to become a mid-term traders, and sometimes you become a long-term investor in the future because they don't want to let go. They want to just want to hold the share, and then since you don't have a stop loss or anything, you can just hold as long as you want. You can still even pass down to the next generation or whatsoever. So this is the benefit of options when comparing to the share and the future, which you have a higher leverage effect and you have a higher tolerance when comparing to futures. And let's talk about call options and put options. What makes it different? Call options, you have a bullish view on the share. But put options, you have a bearish view on the share. So just go back to this example, you can see that if call options, you have this green zone, but you are buying a put option instead, then your green zone will be underneath this 244. So as simple as that. If you have a bullish view, go for call options. If you have a bearish view, you go for put options. And right now, let me check on the time, and we might get to rest a bit for maybe I would say maybe a 2 minutes rest. So if any one of you want to get into toilet, bathroom, or want to get a drink, feel free to do so. And we will come back in 2 minutes and we will get to start to talk about the practical part. We will talk about how I personally pick up the stock and also the options. What is the step to do so? And what is the most important factor you need to be careful when you're picking up an options? If you have any questions for the theoretical theoretical part just now, feel free to ask so I will answer you right away before we get into the practical class. So tomorrow we will talk about the summary of 2024, the American elections, and what leads to the outcome. And then we will talk about the rate cuts, the financial report going to release, the AI and technology industry changes. What else can we talk about? Yeah? Oh, the geographic conflict, which is the war, and also why Bitcoin get to be so bombastic, and just way past the historical high, and also the gold become a very conservative tools for risk averse. We'll talk about all those, and tomorrow class for English it will be me and the others, the others lecturers, which is Jiaming, and we will just discuss it like a postcard way. So instead of just showing the PPT, we'll just do it like a chit chat sessions. So if you're interested to know about the 2024 summary and also the pre-heads up for 2025, do join for our tomorrow sessions, and we will have a chit chat on that. And if you have any question about the macroeconomic view, you can just join and ask so. There's a question from one of the attendees. 能否提供一个中文翻译字幕同步一下？能否提供一个中文字幕翻译一下？中文字幕的话，我们这个 Zoom 的很像是没有这个功能的。不过其实我们会有中文的课，也会有粤语的课，也会有英文的课。然后今天呢是英文的课，上个星期呢我们已经有中文的课了。所以如果你想要参与我们其他语言的课呢，你可以关注一下我们的那个分享链接，我们那个分享链接里面会有其他的课的。 But if you do find very difficult to understand the English, or you want to just have a better understanding on the Chinese term, you can do ask, so then I can have a immediate translations on during the class. Or you can join for our Chinese class or the Cantonese class. But it will be different lectures, so it's all up to you. Okay, so let's get back on today's sections. We'll try to finish it earlier. So for the first part, let's pick up the stock. And let me just show about in a normal day, how do I make a stock selections. So actually, I will suggest you guys to use the heat map like this, so you can know that which industry is actually on fire. And you can see that in the past 1 month, actually all the industry is dropping down, is dying, and only the Google is doing well because of the quant computer things. And the consumer cyclical also looks good, but the Tesla, I believe this is because of the other reasons. And usually I will use a website which is called the Trading View when I'm doing a stock selections. Yeah, just a small reminder. For now, in our class, we won't have any recordings, so that but we will repeat the class every month. So if you just miss up on today's class, you can join for the next month class. But we won't have any recording, so and any replay. So bear with us, yeah. And other than this trading view, I will also use the earnings calendar, because I want to trade for those stock with have a higher volatility, and it will have some bias in the directions. So I will just check on the in what time the earning report is going to release. But you can also check it from the FinViz here. You can just select this, and you can go to the earning date. And you can see that actually the financial industry is going to release the bank sector is going to release the earnings later on. So you can expect the bank sector have a rally in this month. It depends on the earnings. If the earnings goes well, and if reflect on the chart, and it will just go to the directions. But I believe for now, the bank should be doing well, because for the past month, is in the bull markets, right? So I believe that they will be doing fine. And for the stock part, do any of you have any specific type of screening methods? If you guys don't have any special screening methods, then I will just share for my own style. I'll share my own style, yeah. Okay, here, I think the most important part for me when I'm picking up a stock is actually the market capital, the trading volume, and also the direction. So by using this default screener from TradingView, you can actually see that usually you will show like this, the overview sections. And you can see the sectors, the employee part, the most of the fundamental information here. But personally, I will be using the trend following screener here, just for the purposes of screening out the directions. And you can see that it has multiple way of selecting the directions. You have a very strong buy, neutral, sell, or strong sell. So it will be depending on the arrangement of the SMA 20, 50, and also 200. And most of the time, I want to make sure that the stock I'm picking up have a very high trading volume so that I will have no trouble when I want to get into the options and get out of the options. So most of the time, let's go to the basic first. Let's pick for just common stock. You want to just make it simple, don't be so complicated. And for the volume part, I will just need to be above 1 million. So there will be a lot of people trading this stock, and the most famous stock actually do have a higher number of the option selections. And the market capital also need to be big. Just the same reason, because we want to trade the active stock. So market capital need to be big, the volume need to be big, and also personally I will be selecting for filtering for the average volume above 1 million. And I will just do it the same for the 30 days and 60 days because I want to avoid a case that it is due to some news or some financial report release, so that it will have a volume spike for for only those few days. I want to make sure that the stock that I'm trading is in the daily occasion that you have a very high probability and have a very high trading volume, just to make sure that get in and get out without any problem. And for your personal preference, you can also do it by using the EMA here. But personally, I will only do it like this: the market cap, the trading volume, and also for the 30 days and 60 days. And then I will just using the default trend following screener. So right now you can see that there's 381 matches from my screener, and you can see that every one of those are actually a highly traded stock and have a very strong bias in the directions. So in this case, if I'm going to just trade the call options, then I'm going to pick the strong buy or the buy. And let's say that, and you can see that for this one, the strong sell, usually it have a very obvious downtrend. So you can just trade the put option for those. So for today, we will only focus on the call option. So let's go for the buy and the strong buy. And you can see that it directly goes down to 775. So for myself, I'm going to select it by screening the chart and make sure that the one that I'm trading is in a very comfortable area. And I do for one thing, I will do a screener for the price also, because the expensive stock, actually the premium will be more expensive too. Let's do a comparison, like the Warner Brothers Discovery have a share price of just $10. Let's check on how much the share price will be. Let me open up the Usemark interface. Yeah. Okay, so this is the Usemark interface, and let's see that Warner Brother Discovery, the share price is $10. So let's check on the premium, and you can see that there's a lot of selections for the options here, because this is a famous stock to trade on due to the filter. And if you're going to select like those a very small cap stock, you will see that the options here is very limited, and there will be a case where you'll face a difficulties in getting in and getting out. because there's no opponent parties to buy it from you and sell it to you. So let's check on this one for this one, 29 days until the expirations, and you can see that the share price is actually falling on, let's see on the latest price, just 61 cents and 34 cents. So let's check on if I'm going to buy a more expensive stock, this premium, will it goes up or not? Let's say for NVIDIA. NVIDIA is a lot expensive when comparing to Warner Brothers. Warner Brothers, do remember this number, $10, and also the premium is below $1, only 61 cents. And let's see for NVIDIA. And you can see for the same expiration dates, 29 days until expirations, and NVIDIA share price is about 13 times of Warner Brothers Discovery. And then what about the premium? The premium is is falling on $7.70. So if you are a new beginner, I will suggest you to trade for a cheaper stock and a cheaper premium. So instead of just starting out from this very expensive stock and very expensive premium, you can just start from small, start from filtering out the price. So let's say you want to go below 100. And this is the stock that below 100. Since we already talked about the Warner Brothers, let's go for the Warner Brothers. It's standing up, the EMA ribbons and all those look beautiful. Yeah, the same risk disclaimer. This is not a buy call or sell call. So this is just for illustration purposes. Let's say that I want to have a bullish view on this. I want to buy this one. Buy a call option on this. I'm expecting it to goes up at least to the previous support, the previous resistance here. So let us check on how do we able to buy a where is my interface go? Let me see. Did I close it accidentally? I believe I do so. Let me open it up again. Okay, so now we get back to this use my interface. Let's check on Warner Brothers Discovery. Let's say that I have a bullish view on this. I want it to, I want to bet on it to go up. So I want to buy a call option instead. And this is how I'm going to do when I'm selecting. So let's get back to the step. The step on selecting the stock, first of all, we check for the market capital. Then we check for the trading volume. These two factors to ensure that we get in and get out without any problem. Then we want to check for the direction bias. You can either have your own decisions, your own filter or whatsoever. But in this case, we are using the default screener from TradingView. And it shows that we can do a call options or put options for according to the ratings. So this is the three main factors when you're selecting the stock. And then now we will talk about how do we pick up an options. And this will be the factor to consider about. The first one will be the expiration dates. How do we check on it? You can see that the number in the bracket is the day until the expiration. And normally we will pick up the options with 1 month until expiration or 2 months until expiration. Because the further options, you can see that the options actually become more expensive. Like for the $10 strike price, you can see that this one is actually selling on 0.5151 cents, but this one are actually selling on $3.40. So the further the options, it will be more expensive. And for this one, because it doesn't have much room and tolerance for the price to flood. So personally, I would recommend you guys to trade for options for with 1 to 2 months until expiration. So you can either pick this one. These three, I think, will be perfectly fine. And then the next thing to check on is the volume, the trading volume. Why? Because we want to make sure that we're able to get in and get out without any problem. So you can just scroll this and then you can check on this volume. And you can see that among these three, these two actually doesn't have a lot of trading volume because the trading volume actually just allocating around the current price. And for the further strike price, it doesn't have any people to trade along with. So we want to avoid trading these two options instead. So in this case, we'll be focusing on this one. But if you check on this one, the volume actually is low too, because if you want to trade for only 1 to 2 contract, you'll be perfectly fine. But if for this one, it is only trading in a 2-digit number of contracts. So I would prefer not to trade along with. Let's see on a gold, let's say GLD. Since we are using the gold for the illustration in theoretical past, so let's check on it. Whoa, the number of contract trading is actually very low also. Seems like it's not a good timing to trade for gold options. How about Tesla? For those should have a higher trading volume. Yeah, a little bit better. At least it's more than 100 contract. But this is expensive to trade on. Let's get back to the Warner Brothers one. So if you're going to trade for options, do make sure that you want to trade for those have a higher trading volume. In this case, this will not be a very good example because the volume is actually very low and it's concentrated on around the current price. This is not a very good example, but we'll continue with it. And let's say that, and the next thing to check on it will be the open interest. What does the open interest mean? Let's say that you click on this one. The open interest here, you can see that it's 62 contract, which means that there is like 62 opening contract right now. There are 62 people have either one people with 62 contract. They have a bullish view on this one. So usually we want to trade the options with a higher trading volume and also a higher opening interest number. Why? A higher trading volume can allow us to get in and get out without any problem, and a higher open interest can ensure that there are a lot of people on your side, so you are not alone. So when the price is going up, there's a force to push. There's a hidden force to pushing it up. So even though by theoretical means it should go up to that level, if there's no trading volume, it's very difficult to get to that level instead. So we want to make sure that there's enough volume trading that can support the price to goes up to the location that it should be falling on. So now we'll check on the fourth one, which is a strike price. How do we select the strike price? Normally, I will recommend people to just trade for the out the money one, this one. Let's say that you have a bullish view on this one. I will recommend you to, right now the Warner Brother is falling on $10 something. So I will recommend you to trade for maybe a strike price of 11, 12, 13 or something. Why? Because first thing first, this is cheaper when you're comparing to the in the market options. So the second thing is, it also have a higher leverage effect. You can see that the effective gearing here is a lot bigger when you're comparing to the last one. This is due to the limited trading volume. But if you check on those with a higher volume, it should be greater than those above. And the last thing is the implied volatility and the historical volatility. Let's go for a better example. This one is way too ugly. Let's say for Plantic. Yeah, so if you check on Plantic, the trading volume here is sufficient for you to get in and get out without any problem. So if you only want to buy 1 to 5 contract, then this will be more than enough. And the second thing is the open interest. You can see the open interest here is a lot bigger when you're comparing to the last one. So this is also a better option to trade with. And then the next one, we are going to select for the out the money options. And if you are very confusing about what is out the money, in the money, and at the money, all those terms, you can just referring to the previous class. We have talked about it. And I'm not sure whether the recording is still there or not. But if you are very curious about that, do stay tuned with our channel, and then we will maybe have some short videos or to just introduce all those technical knowledge. So let's say on this one, we are going to select the out the money one, which is the one that below the current market, above the current market price, so that we can either select the 76 strike price, 77 strike price, 78 strike price, whatsoever. And then you can see that, first of all, it is cheaper when you're comparing to the in the market. And the second thing is the leverage effect is also greater. So when it goes up, we can make a lot bigger when you're comparing to buying those have a lower strike price. So let's get back to this. First of all, expiration date 1 to 2 months. Second, volume need to be high. Open interest need to be high. More than 100 will be better for these two. I will say more than 100 contract. And the third one is the strike price, which is out the money, because cheaper and greater leverage effect. Then we will check about the implied volatility in the historical volatility. This will be the fair value of the premium of the options, I will say. Options. Okay. So let's get back to it. Let's say that I want to buy these options. Let's say that this 76 one, And right now it's falling on what price? Let's see. The last trading price will be $5.35. How do I know is this number cheap or expensive? This is how we do. We check on the implied volatility here. You can see the implied volatility here show a 63%, which means that we can comparing it to the previous historical volatility. The higher the volatility, more expensive it will be. Plantic. Let's say that I want to buy it right now for it betting it to go up. And how do I know is it cheaper or expensive? Let's imply volatility. Yes, right now you can see that the implied volatility here is around 67%, which is around the same with the one in the UseSmart interface, which is 63%, and that one in TradingView shows 67%. So in order to understand in the normal circumstances, what will be the normal implied volatility it will be. So for normal circumstances, the implied volatility actually float in between, I would say 40 to 60. I will take the medium range, which is 50. So let's say that the implied volatility do drop in the future and get back to the normal range. What is the price of this premium will be allocated on? Let's do a simple mathematics. So right now that I understand, this option is actually selling in a very expensive way, because normally the implied volatility will be around 50, but right now it's about 63%. So I can just deduct the 63.29% deduct by 50. So this is the volatility rate that you need to drop for it to get back to the fair value of these options. So you can just multiply this by the Vega value, 0.087, 0.087. So if the implied volatility drop from 63% to 50%, this one, 5.35, will drop about this range. So I would say 1.15, 1.156. So 1.156. So the fair value of these options is actually around $4.19. This is the fair value of these options instead of this one. So right now, this is actually selling in an expensive way when you're comparing to the fair value. So if it drop below to this value, it will be worth to invest. It will be worth to trade. And how do we understand this implied volatility things? It means that if the price of this stock doesn't go up or go down, the Plantic doesn't go up and go down, but the market view it on a different angle. Like implied volatility mean in this way. Let's say the Plantic is right now $100. So in the market thinks that in the coming 1 years, Plantic will move for about 63%. So it will either become $163 after 1 year, or it will drop about 63%, and you will be allocating, it will be falling on $37 in the future. This is how implied volatility can be explained. So if the price of Plantic doesn't go up or go down, it's just that the market view it differently, doesn't have that kind of volatility expectation on it, the premium will actually drop. How much will it drop? You can just check by this one. you can check from the trading view and get to know about the fair value of the historical volatility. And also, after that, you can just do a mathematic to get a fair value of this premium instead. So right now, we already know about how you pick up an option instead. You check about the expiration date and make sure that it have a very high trading volume, a high interest rate, not interest rate, a high open interest, and about the strike price, choose the out the money one because it's cheaper and have a greater leverage effect. Then we check about the fair value of the options by using the trading view historical volatility. Then the last one will be limit order and market order. Let's say that I want to buy this option instead. And you can see that sorry for my line getting bad. It doesn't reflect along. Sorry for my broken internet, but this is actually how you view it. Let's wait for it to get response. Yeah. My line is pretty bad here, but never mind. So let's say that there will be a bid and ask price here. If you are a total beginner, you can understand the bid and ask in this way. In this way, the ask price is the lowest price that the seller willing to sell. So, and the bid price is right now the highest price that the buyer willing to buy. So if you want to buy this one immediately without any concerns, you can directly place an order at $5.40 to pick up the seller order. And if you are patient people, you can just pending at the $5.20 waiting for the seller to sell you on that price. So this is how you understand the ask price and the bid price. So you can actually do it in the limit order type or also the market order type. If you are going to the market order type, then you are going to take up this $5.40 order. And if you are doing a limit order type, you can pen lower than that one. You can either pen for $5.30, $5.20, and even lower, about $5, $4 something. It's all up to you. So normally I will do it in this way. I'll pen an order in between the in between the ask price and also the bid price. So just to ensure that I'm able to get in without any problem. Because first of all, we already pick up the very active trading stock and also very active trading options. So right now, I want to get easier when comparing to the current market player. I just placing the limit order in between the ask price and also the bid price will do. So this is how you're going to pick up an option instead. Let's recap again. First of all, what is the stock? We want to have a screener of the market cap to ensure that we get in and get out without any problem. And also the trading volume, also do the same. Then we want to have a direction bias. You can do it in your own way. And we do also have the technical analysis class, but I think in the short future we'll do. and it will be conducted by different lecturers, and every one of us have a very different way of technical analysis. So do stay tuned, yeah. And then after that, you pick up a very good share options, no, a very good stock. Let's add on about the last one, the share price range. So you want to buy for expensive options, you can go for the expensive share. If you want to go for a cheaper options, then you go for a cheaper stock. Then afterwards, we picking up the option for the share, for the stock. So first of all, we pick the expiration dates. Then we check on the volume. Need to be a lot greater when comparing to the order that you want to place. Then we check on the open interest. Afterwards, we will check on the strike price. And how do we select the strike price? We select the out the money strike price, which is a lot cheaper and have a greater leverage effect. Then we will check on the current implied volatility and also the historical volatility, just to ensure that the fair value of the option is check on the fair value of the options and ensuring that we are buying the option in a cheaper rate. The last thing is you can place a limit order or you can place a market order. If you want to get in without any concern, do go for the market order. If you are a patient people and you want to have a better pricing, so you can go for a limit order. As simple as that. And this is for today's class. And next week we have a seller class instead. And this is my quotations. I would say completion is more important than perfections. The knowledge is all in the market and you can never learn until the end. So make sure that you can just start first and then refine later on. And if you want to join for our group, our communities, you can contact your manager to do so. And this is how you contact your manager. You go to the apps and you select the last icon, and there you will see a tab called manager. And you click on the manager there, you can just connect to your manager, and then you can able to get invited to our community. So this is all about today's class. If you guys have any question, you can ask so. Else, I will stop for today's class here. And hopefully we can see you again on next classes. And next classes, we are going to talk about the seller part, the beauty of becoming a seller. And it will be a different angle when comparing to become a buyer. A buyer, the advantage will be you're actually using a very small amount of bet to get a jackpot, a lottery, I would say. But for the seller part, is actually using a larger capital to gain the interest in a very consistent way. So different angle of playing things around. Okay, so it seems like there's no more question from you guys. And thank you for joining. I will stop for today's sessions here. And hopefully to see you guys again on next sessions. Bye. And Happy New Year.